Would you buy a used car without looking under the hood? Of course not. Now the same goes with buying stocks, right? You don't invest in a company without doing your homework. Hi everybody, I'm Jordan Murphy and welcome to the ROI Minute. So as we know, investing in a company through stock ownership is a very common practice. And depending on what you pick, it can turn into a great investment or, as some have come to know, a tragic failure. Now, ROI Catalyst feels that to avoid the latter, you need to research the company as much as possible. And the best places to start with are these big three filings: the 10Q, the 10K, and the proxy statements. Now the 10Q, or quarterly reports filed 3 times a year, usually about a month after each quarter ends, is an expanded version of an earnings statement. And the information for the fourth quarter is included in the 10K, which is a much more detailed version of the annual report. We don't recommend that you rely on the glossy version sent to the share owners. These often contain more fluff than substance. What we think is you should read the larger version, because here you can find the real gritty details that the company often doesn't really want spotlighted. Now, these reports can be found through the SEC site or on a company's website, typically under its investor relations section. Now, once you find them, print them out, then take the footnotes at the end of each document and read each one as you come across them in the report. See, it's in these footnotes that you can often find the hidden nuggets of information. Now, do you have to read the entire report cover to cover? No, but take the time to skim the highlights. Look for the company's risk factors. Are there significant new lawsuits? Is there new management in place that doesn't seem as experienced? Now, finally, the proxy statement. It's officially known as the DEF 14A, and it's where you will find the real juicy stuff. See, this is where you find out how much compensation the managers are making. If the top brass is getting huge raises when stock prices are going down, this is a red flag. Now, obviously, there's a lot of information to go through, but we think you should take the time to do it, especially if your money's at stake. Consider this. If you buy stock in a clothing company without looking at these filings, it would be like buying that used car without giving it a test drive. So here it is. The bottom line is, analyze the stock before you buy the stock. Simple as that. As James Cramer from CNBC's Mad Money once said, those who value stocks by eyeballs should go to ophthalmologists, not stock analysts. To find out more detailed tips on how to navigate these filings and more, just check out the blog right here on ROICatalysts.com. It's written by co-founder of ROI Catalysts, CEO David Morrill. You can always find us at ROICatalysts.com or friend us on Facebook at facebook.com/ROI Catalysts. Thanks everyone for watching. I'll see you again next time. Thanks.